Well, good afternoon. This is Mike Rains with Remax Aerosol here in the Huntington Beach, Orange County area of California. Where should you put your money? With all the investment choices that are out there today, whether it's cryptocurrency or CDs, bonds, the stock market, all those kinds of things. Today, I'm going to show you an example of a personal example of mine as to why I think real estate is one of the best choices that you could possibly make your investments in and why it's safe over the long haul. So I'm going to go through that in detail right now. I'm going to share my screen in the presentation that I made for you, and we'll start it off right now. So I hope to make this case for you and why I think investing in real estate is the best opportunity and the safest opportunity with all the volatility that's in the market today. Real estate also has a volatility, but over the long haul, it's proven to be a very good result. And I want to show you how that is today. So I want to share an example about when I bought a condo. I bought it back in 2005. Late 2007, though, I got married and we decided to keep the property as a rental property. We moved in together in our main house, but we rented out that condo. So one of the things that's awesome about investment real estate, they call it other people's money. So you're using other people's money to be able to bring in, the monies necessary to pay for the mortgage. In this case, it was a condo, so the HOA dues, the property taxes, all those things. But in 2008, right after we got married, the housing market crashed. So the whole thing came down in a big way, and there was many reasons for that. But you guys have maybe heard of this thing called the Great Recession, and I just sold it this last year. So today, I want to share with you that the statistics are out, and the average homeowner, as opposed to a realtor, has 40 times the amount of wealth and net worth than a renter does. And so I'm going to give you this little example of mine to hopefully bring you like the numbers, because I bought that place right before the market crash. So many people are asking me today, hey, Mike, should I be investing in this market? We've been going hot and heavy since 2010 when the bottom of that market came out of the Great Recession, and it's been going hot and heavy. And today is no different. It's up, 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 up. And it looks like things are starting to make some new trends and changes where it might cool off a little bit. But there's a huge difference between the market that we're in now and the market that we were in back in 2008. So just to review what I did is I bought a condo back in Mission Viejo for $285,000 near the top of the market in mid 2005. Turns out 2008 was the top and that crash came down. But I put 5% down, which was $14,250. I did it on a 5/1 ARM, and I ended up keeping that loan for a long time. Closing costs paid were $2,330. And then the real estate market crashed, and they crashed differently because there was what we called liar loans and no down payments. You just had to have a credit score and a signature and basically a heartbeat, because the banks were giving away money and you didn't have to prove your income. In fact, you didn't have to put any money down. And so because of those things, when the time got tough, people walked away from their properties more so. And today that is not the case. People are putting 20, 30, 40, 50%. And you hear about a lot of people actually paying cash for properties. So there's a lot of people that have a ton of equity. So that's a big difference between what's happening in the market today and what happened back in 2008. But I had rented it out. And this is the secret sauce here that I wanted to share with you today. I rented the condo out while we were living here in Huntington Beach. And I covered 95% of the total cost of owning it: taxes, insurance, payments, HOA dues. And that difference was $93. So I made up the $93 difference every month to cover that. And I rented it for a total of 13 years using other people's money, which is awesome. So, but I didn't have out-of-pocket expenses. So for that $93, calculated over the 156 months that I owned it as a rental, that's $14,508. That was the shortfall total over the entire time. So I just want to make that clarification, because we're going to add these numbers up. So some other costs to consider in investment property is that you have to do some remodeling every now and then. So I did some remodeling. And so the cost that I paid out of pocket, both in the beginning when I lived there, and then also at the end, it totaled up $38,250 in all. Some additional costs that I had is maintenance over the years. Toilets break, there's electrical work that needs to be done, plumbing. I had to replace a refrigerator, some appliance fixes and things like that. That's just part of having a rental property. The nice thing is that comes out of the rent. So when you're claiming stuff on your tax return, all those expenses get reduced by the amount of rent that comes in. So the rent pays for those things, but it is out of pocket. We got to calculate that in with the total of expenses. So my total out of pocket expenses between the down payment, the maintenance, remodeling, the monthly shortfall that we talked about, the $93, the total over the 16 years that I had it was $75,658. So that's out of pocket cash over 16 years. So what's my return on investment? And this is where the power of having another renter, the market changes. Even though we went through the Great Recession and the market crashed, I sold the property in July of last year for $376,000. Now, at the height of the Great Recession, helped my brother buy the exact same unit that I had for $160,000. So temporarily on paper, I paid $285. It went down to $106. I think he paid $161 or something real close to that. So there was a huge drop in the value of that. And so this isn't making the point for me. Now I just sold it for $376,000. And I had $12,200 in $220 in closing costs, which came out of the proceeds. So that wasn't really out of pocket, but I'm including it with the reduction there. So the mortgage balance that got paid off in that was $96,000 by that time. So you can imagine 5% down when I had a tenant paying me rents. I was paying the mortgage and a little extra that I would chip in, and $96,000 was the balance after 16 years. So I reduced that quite a bit. And that's how you build equity, is through that. There's two ways: appreciation of the market, and you're paying down your principal balance that you owe on it if you're not paying cash. And that goes into your equity pool there. But 95% of it was being paid for by a tenant. So other people's money. Remember that. So I actually walked away with $267,780 cash in the bank that I put in. That's a total of 353% total return on my cash on cash return. So my 75,000 that we talked about, 75,658, I turned that money into $267,780. So if you think about the math on that, over the 16 years that I had that property, I had an average. If you take that 353 and divide that by 16, you come up with 22.06% return annually. So not just over one time, annually, every year, 22,006%. So 22.06% return on that. And that's even with a market crash in the middle of that. So in fact, in the beginning of it, it took a decade for it to come back. So short term, don't worry about it. You get a renter in there and other people's money, you're paying your costs, and you're going to build equity over the long haul. And it was a personal decision for me to sell that so we could do some other things with that money. But that kind of gain is what I'm talking about with real estate. And I don't know where you can put your money today, whether it's Dogecoin or Shiba Inu or Bitcoin or any of those things, or CDs. The stock market's a good place too. Over the years, there's a good return. I think it's 10 or 12% on an annualized basis over that. And it has its ups and downs too, but it's really volatile right now as well. So really, when you look at what the bank's paying you at 0.01%, doesn't make any sense with the inflation rate at 8.5 right now, that you're losing buying power at 8.5% every single year, that you would not just have cash sitting in the bank that wasn't intended for like emergency funds and stuff like that. I'm talking about your investment money. So if you're going to be putting that in, you don't want to just have it in the bank. You don't necessarily want to put it in CDs unless you're at the age where bonds and CDs just make sense. You're not looking for appreciation anymore. You're just looking for preservation of capital. So, but by and large, really, as I've just demonstrated, you are able to buy residential real estate and make it an investment property. This isn't your primary residence. This is investment property, and use other people's money. And you can see these same kinds of cash on cash returns that over the years, you'll look back and you'll just be blown away, and so glad that you made that leap to do that. Even in the market where we're at now, where we might be near a top in the next year or two for a while, but that's normal. That it can't go straight up every year, for 100 years. But when you look at the charts, it goes up, it goes down, it goes up, it goes down, but it's generally speaking on an upward trend. And that's because of the system that we're in with inflation. It's built into the way we do things in our economy. So long-term picture looks awesome for residential real estate and units, duplexes, fourplexes, units, things like that. So if you have any other questions on that, feel free to reach out to me, drop a comment in the section below, as well as like this video and subscribe to the channel. And if you want to reach out to me directly and run some scenarios on that, I'd be happy to do that. My information's in the chat. So I hope you have a fantastic day, and we'll talk to you later.